Excellent. Well, good afternoon, everyone. My name is Jack Moriarty. I'm the Executive Director of the Lafayette Square Institute. We are a nonprofit public policy organization committed to accelerating wealth for workers and communities, including through the growth of employee ownership. I'm thrilled to be joined by a number of colleagues for today's discussion, Christopher Mackin, and Bryce and Dick May from American Working Capital, along with Vishnu Amin from Lafayette Square and Stephen Babson from Endeavour Capital. Our discussion today is going to be focused on an update of recently introduced bipartisan federal legislation called the Employee Equity Investment Act. And I'll start with a very quick overview at a high level of the mechanics of the legislation, what it's all about, why private capital providers in the ESOP market should be aware of it, and then most importantly, we'll hear some reactions from colleagues in the discussion. Back in May of this year, as I mentioned, the Employee Equity Investment Act was introduced on a bipartisan and bicameral basis in the House and Senate. In the Senate, it's being led by Senator Chris Van Hollen and Marco Rubio. And what it's designed to do is address a capital gap in the ESOP market, whereby most ESOP transactions, new formations, are substantially seller financed. Whereas the bank is only coming in, the lender is only coming in for so much of the transaction, and these transactions depend upon subordinated long-term seller notes. The theory here, among other things, is that if we can use the tools of federal credit enhancement, we can mobilize additional private capital into the market to provide the kind of liquidity event for sellers vis-a-vis their alternative exit options. And by doing that, effectively lower the opportunity cost for sellers that are looking to receive this substantial amount of their proceeds at closing. And on the investor side, increase the return profile through the availability of long duration liability at concessionary rates to invest in ESOP transactions that generate competitive risk-adjusted returns. How would this work? The bill expands an existing program at the Small Business Administration called the Small Business Investment Company Program. It's been around since the 1950s. And what it does is it provides long duration concessionary debt financing to privately licensed funds, essentially a public-private capital partnership with SBA. The EEIA legislation is designed to expand the infrastructure and capabilities of that program by adding an adjacent credit facility that's designed specifically for a new class of what we call employee equity investment companies, or EEICs, which is would be a new license class for funds that invest the bulk of their capital in both the growth of existing ESOP companies and, of course, the formation of new ones. This won't be as pertinent for today's conversation around private investment, but I should also note that the bill also solves another pain point in the ESOP field, which is the fact that if you are an existing minority-owned, women-owned, or service-disabled veteran-owned business, you currently cannot sell a majority of your business to an ESOP or a worker cooperative, for that matter, without losing that designation. And EEIA would also take steps to remedy that issue. So without further ado, very quickly, I'll share, again, these are the co-sponsors, at least the lead co-sponsors in the House and Senate. Additional Republicans and Democrats in both chambers have since come on. So we are excited by the bipartisan support for this legislation, which is no different than previous ESOP legislative efforts. With that, I'm going to hand it over to my colleague, Chris Mackin, to give us some additional introductory remarks. Chris, if you want to come up on mute.
Yes, thank you, Jack. Sorry about the mute. I'm Chris Mackin. Wear various hats. I'm a Carey Fellow at Rutgers, and I'm a partner with Dick and Bryce at American Working Capital, and a founder of my legacy company here in Cambridge, Massachusetts, called Ownership Associates. My purpose in helping kick this off, and we're going to have some discussion among the panelists going forward. I'm sort of backing up Jack as a moderator here. Is to sort of try to sort of answer a question that might be in our audience's mind of like, well, who's paying attention to this idea, and why is it becoming relevant? Well, here's a fellow that people in the private equity community know and the investment community know. Tom DiNapoli, of the New York State Comptroller's Office, who we learned late last year, and I learned this from his staff, that Maria Doulis, that Tom himself asked for this research to be done. He's curious about what this ownership structure could mean for New York State. And he is obviously sits atop a major fund, and he's asking questions about what this is and how it can benefit the state. I would urge our audience to look at that link at the bottom, and we could get the information to you. Tom was interested to learn that, just to give a tiny bit of color, that New York State is fourth in the ESOP count in the United States. They've got 313 ESOPs in the state out of about 6,500 in the country. It's first in assets because there are some big publicly traded companies, IBM, JP Morgan, Verizon, and Pfizer have ESOPs, but they have 313 total ESOPs. They fit the general profile of closely held businesses that have been sold internally on a tax-favored basis to their people, and they're doing quite well. They are 5.2% returns have been studied for 401ks in the state, 5.9% returns on ESOPs. And so Tom is making the case this is something he's interested in. We're hoping certainly that his office and some other LPs will see to it to help us now that we have a legislative framework, and to help the investment community put the capital together to actually make this happen. One other brand that people will have heard of, next slide, Jack, is TIAA-CREF, that was an early mover, a very large LP, obviously, who very early mover in this field, that is supporting a small fund of Mosaic Capital, about a $200 million fund. In fact, they're into their second fund. And the Kellogg Foundation has been a supporter of APIS and Heritage. This is just again to illustrate that this idea is on the radar of LPs, and more people want it to happen. But we are very much at the beginning of the growth of this as a professional specialty, particularly in private equity. And without taking any thunder away from Dick, because we're going to turn it over to Dick next, we might ask the question, well, why do we, if this is already happening, why do we need a law? Well, we estimate that ESOPs are about 0.1% of M&A activity in the United States today. And so if the frame of reference for what we're doing here is a kind of inclusive M&A that helps workers and communities, we're just getting started. And we're having to solve a problem that is one of the most common sense, obvious problems that intelligent people, when first asked about employee ownership or posed the idea of employee ownership, is what do we do? Workers obviously don't have the money to buy companies. Workers and managers don't have the money to buy companies. There's a missing equity piece of the puzzle. And that's one of the reasons why we wrote this law, is to be able to supply the missing equity. Healthy companies with healthy balance sheets can do the senior debt, maybe some mezz debt, but the equity piece has been missing, and that's why we're 0.1%. And hopefully this law will move the needle into a more mainstream partnership with the existing private equity community. So I think I will then now turn it over to Dick, and we're posing the question for you, Dick. You are the one, you had some help from your friends, but you're the one who came up with the idea, and we could probably go full screen here now, Jack. You're the person who, the itch was scratching, and you decided to sit down and start typing away on this. And could you tell us what the genesis of that is?
Oh, sure. Thank you, Chris and Jack. Well, first of all, I'm Dick May, a founding partner and a continuing partner, American Working Capital, a middle market private equity fund. We have a bit of a knowledge and depth in employee ownership structures for businesses, but we do a lot of other things. But to set the tone, the history of where this all came from, I have to turn the clock back a bit. When I got into the business of advising, establishing an investment banking firm that advised closely held businesses, one of the things that I found that I most enjoyed was working with employee-owned businesses. I learned, like we all learn, by studying other people who are more knowledgeable of how to structure these businesses using ESOPs. We did a lot of other work, but early on, I made a point of studying the businesses that we transacted with and following their progress. And what I found was I really enjoyed the ESOP structure. What I found was the employees were better motivated, more productive, and created much greater wealth than firms that did not adopt this form of ownership. On the whole, there are exceptions to that, of course. But so I started paying a lot more attention to employee ownership structures. What I determined was that there was a great burst of growth in the spread of employee ownership. There are about 14 million workers today. I think Chris mentioned what was going on in New York City or New York State, but about 14 million workers. That's less than 9% of the workforce of private employee-owned companies and non-employee-owned companies today in the country. And that ownership percentage on the part of employee ownership structures actually peaked about 15, 17 years ago, and has been flat pretty much for the remainder, even though the adoption of these structures is more broadly spread and is they're being created at a rate of about 215 to 235 or 40 a year today. They're also being bought at a significant rate by private equity, senior developed companies. And I discovered in the research that I was doing that one of the chief contributors to this trend was the most successful of these employee-owned businesses were reaching their growth goals at the same time that they were cashing out their legacy long-term employee owners, and that the available capital sources to draw upon to meet both the repurchase of the employee owner's stock and the investments in the growth were very limited. And so I started thinking about how do we expand the knowledge structure of these of this form of ownership in the U.S. market. And one of the key times that contributed to what we call our EEIA today was a meeting I had with John Cardinell, who is chief of staff of Kristen Gillibrand.
At the time.
And they were working, this was 2014, 2015. They were working on a new bill called the Main Street Employee Ownership Act. And because of our knowledge of these transactions, we were asked to advise them. And Chris Mackin and myself met with their staff. We had done some research on the provisions of this plan, and I came back and told them something that they didn't want to hear. And that is that act would probably have almost no measurable impact on the adoption of ESOPs, even though it was going to be a difficult and time-consuming legislative push to get this bill passed. John wasn't happy with my analysis and my advice, saying that, you're putting a lot of muscle and effort and resources into getting this done. I don't think it's going to have a big impact. He turned around and said, well, okay, Dick, then what would? What would be, what idea, what way can I take back to my senator and others that are aligned and want to support the growth of employee ownership? What would make a difference? And so I remember leaving that meeting and thinking, that's the right question. if we want to grow employee ownership and it's not growing now, how can we come up with a legislative or a structure that will attract institutional capital to this market and spread employee ownership? So I started thinking about that problem. One of the, besides Chris, one of the strong contributors to maturing that idea was Bob Hockett of Cornell, who we had a train ride from one of the Rutgers University meetings to New York City. And on that train ride, I brought up this idea and we started batting it around. And I said, the only way, the way that I think about this is that the greatest contributor to wealth for U.S. workers are their homes, the equity they have in their homes, and the research that I had done. And I said, homes appreciate an interesting rate, but significantly below the rate of the capital for the capital interest for the businesses that they work in. So how can we use that model of government support in terms of providing home loan guarantees for home loans for U.S. workers for buying an interest in the businesses they work for? And I remember Bob's eyes light up and said, that's a fantastic idea. That's one of the greatest, credit markets in the world, these loan guarantees for mortgages. And why don't we, let's flesh this out. So I took both Bob's ideas and Chris's ideas, and together we wrote an article that was published by Challenge Magazine in January of 2017. So it's a year and a half or so of work to get this into a presentable form. And lo and behold, one of the wonderful things about pounding your manifesto on a door is some people go through that door and read it. And so that manifesto was read by a couple of senators. Chris has mentioned them, Mark Rubio, and particularly Chris Van Hollen early on, Dean Phillips in the House, Houlihan, some others. Actually, their staffs read this article and said, hey, how can we help? And so that ended up becoming, after a lot of work on the part of Jack Moriarty and others, developing legislation, took a modest idea that the three of us, Chris, Bob, and myself, formed on that train ride. And it's basically a product of that legislation today. So that was the genesis, and I'm very hopeful that this is a new capital source for growing current ESOPs and also for creating a lot more employee-owned businesses in this country.
Thank you, Dick. And I want to go over to Bryce. Bryce, you've been articulate in the past about the tool of ESOPs interacting with the SBIC as a proven infrastructure, and of course, institutional capital in the form of private equity as sort of three tools coming together. Would love to hear your thoughts and reactions as you've gotten up to speed on this legislative opportunity and how you see it interacting with the ESOP market.
Sure. Bryce May with American Working Capital. Pleasure to share some thoughts. Jack, as I see it, more or less from a practitioner's lens, I think the EEIA proposed framework speaks directly to at least two or three meaningful challenges that have constrained the opportunity set for the ESOP community. And obviously, I'm going to speak in generalities, but one of those being a meaningful reliance, particularly in change of control transactions, on seller financing or installment sales, which I think constrains the opportunity set and sometimes makes an ESOP, particularly in a majority or change of control context, less competitive with other ownership transition alternatives. I think also, generally speaking, the marketplace has, in my experience, been characterized by perhaps an over-reliance on debt, whether that's external or internal. And that means that at times it leads to situations where you have a less flexible or more constrained capital structure. And the other third principal challenge that I think this framework speaks to is, as Chris referenced earlier, a lack of equity or structured equity, which leads to trade-offs, because if you're relying upon debt or seller financing, oftentimes there's significant trade-offs between affecting ownership succession objectives versus growth objectives in the business. And ideally, equity capital or junior capital has an opportunity to draw that compromise at times. So there's obviously numerous examples of highly successful founder, management, and employee-led businesses that have sponsored ESOP transactions and grown and developed fantastic businesses and delivered significant value to their employee participants. But as Chris referenced earlier, ESOPs and ESOP ownership, capital and ownership structures are significantly underrepresented in the U.S. middle market or privately held marketplace. And I think the principal reason for that is a lack of depth and scale to equity capital. So, I think the EEIA framework and the construction that Dick just referenced brings some distinct benefits and some unique opportunities to the private equity community, as I see it. And I think there's three things that come to mind. One is the math works. It's not the proper venue to go into the details or the weeds on it, but if you look at the way this is framed out, the credit enhancements, the embedded cost of capital, I think the structure allows you and enables and enhances to drive market-based returns while also sponsoring meaningful participation in the equity value and value creation in the businesses, what is traditionally perceived to be quote unquote dilutive. And I say real or perceived dilution because I think at least amongst this panel, we have all borne direct witness to the fact that ESOP structures, there's plenty of evidence of objective performance measures and tax efficiencies to these structures, but the EEIA framework definitely provides a meaningful quantitative enhancement on a risk-adjusted returns basis. And also, and maybe Stephen or Vish will speak to this as well in their own experience set, but I think this is a tool that will enable institutional private equity to come to the table with prospective partners with a very, very different partnering structure. And that ultimately leads towards differentiated deal flow and really unique privately negotiated partnering opportunities. And lastly, I would say, I think it's a meaningful risk mitigant. As a sponsor, affecting growth capitalizations or change of control transactions, you're obviously focused on the upside opportunities, but there's meaningful discipline that you look to apply with respect to underwriting risk, protecting and preserving value. And I can't think of a structure that has better alignment of interest and speaks to, provided that you invest time and effort in the communication and a thoughtful and intentional approach to a benefit and incentive structure. But when you push that down in the organization in a holistic way, I think you have a very unique alignment of interest and you're broadly addressing principal agent conflicts that emerge in these sorts of transactions. And lastly, I guess, Jack, maybe it's a self-serving comment to, ourselves on the panel and some in the audience, But I do think there's really very meaningful benefit to the ESOP community prospectively, not just in terms of scaling the universe of ESOP-owned companies with greater access to capital, but I also think there's real benefit to institutional stewardship and governance. And when you can enhance the opportunities for institutional capital to partner with founders, management, and employee groups on the stewardship of these businesses, it's not just depth of capital, but it's access to expertise and a network of opportunities that I think private equity has a very well-established track record in terms of stewardship and value creation with privately held businesses. So this could be a very interesting bridge between those two communities.
Excellent. Thank you, Bryce. I'm going to go over to Vish. Vish, you're sitting in a different part of the capital structure than our friends at AWC and at Endeavour. Would welcome your perspective, your experience in the ESOP market, and how you see the opportunity for a long duration liability facility playing a constructive role in the growth of employee ownership.
Yeah, absolutely. Thanks, Jack. So by way of introduction, I'm Vishnu Amin. I'm a director on the investment team here at Lafayette Square. We at Lafayette Square are a middle market private credit firm, and ESOPs are near and dear to my heart. One of the earliest investments in my career was actually financing an ESOP conversion. And coincidentally, Lafayette Square's first loan was actually also in support of an ESOP conversion of a waste recycling business. And I'd say between those transactions and several others, I've seen firsthand the impact that broad employee ownership can have on the people and the communities in which we invest. And so when I think about the benefits of ESOPs, I kind of think about it across three categories: risk management and employee alignment as one. Employees, generally speaking, are the lifeblood and most valuable asset of any business. And so my simple take is that better employee outcomes will lead to better business outcomes. And as a practical matter, alignment tends to be a key factor when we evaluate investment opportunities. And in most cases, you tend to see ownership as being closely held by founders and/or private equity firms, perhaps with some level of management incentive plan to keep the leaders engaged and incentivized. But it's rare that companies distribute that ownership more broadly down through the entry-level employees. And so what I'd say is an observation is that businesses that do tend to drive higher job satisfaction and productivity, which ultimately leads to higher employee retention. The second category is structural tax advantages. The most obvious one is the corporate tax exemption for ESOP-owned businesses, which at its core can help provide increased free cash flow for businesses. That cash can then be used to either reinvest in the business or its employees. And when you think about it from a seller standpoint, there's an interesting opportunity to take advantage of what's called a Section 1042 rollover, which in short allows for deferred capital gains from a sale to an ESOP. And so you have a situation whereby a founder can effectively sell his or her business to employees at a price that favors the employees while still earning the same after-tax proceeds as a non-ESOP sale at a higher price. And so that's a benefit that certainly is helpful for a seller and a founder that has goals of transitioning ownership to the employees. And it's something that bodes well for employees because they, in theory, have an opportunity to buy at a partially favorable price relative to what might be otherwise market clearing. And then the last factor is really wealth creation. And so when I think about the opportunity here, an appropriately structured ESOP really has the ability to generate incremental retirement savings that are equal to multiples of gross annual income for these working class Americans, many of whom may otherwise be unable to adequately save for retirement. And so this is a true zero cost to employee benefit, unlike 401ks or Roth IRAs, which still require some level of employee contribution. And so that brings us to the EIA and the value proposition as I see it. I think the short answer is that it should lead to better outcomes for companies and their employees and communities. The longer answer, and we've talked about it a little bit here, is that there's a financing gap in the ESOP marketplace, primarily as a result of how capital structures tend to be set up. So as we discussed, there's third-party debt for, call it, the first couple turns of leverage. That could come from a private lender such as ourselves. It could come from a commercial bank, although we know that commercial banks have been pulling back recently and tightening lending requirements. The balance, which is the lion's share, comes from that seller note. And as we've discussed, there are currently only a handful of institutional equity investors that really understand ESOPs and have a desire to provide what is a structured equity security that could replace the seller note. And as I think about the SBIC fund landscape, those have long been an attractive investment vehicle as a result of long duration fixed rate leverage to really support investment into small businesses. And so from the perspective of a firm that has an SBIC fund, I would say adopting a similar framework, but specifically tailored for ESOP financings, inclusive of concessionary leverage, to really help drive meaningful capital flows into ESOPs as a result of these sharp investors that are looking to generate alpha while still doing good. And I think this proposal, which includes elevated size standards, should help broaden the universe of potential ESOP companies. And the increased fund and leverage caps as proposed should also increase investor interest commensurately. So this is something that I'm excited to see come to fruition.
Thank you, Vish, and appreciate you also raising some of the details on how the EIA facility would be different. Just to restate it, what you shared, you can get through EIA up to $350 million in concessionary leverage on a one-to-one basis. So you raise $350 million of private capital, that can be levered to one-to-one for a $700 million fund. And that, coupled with the size standard increase, is designed to try to bring private capital flows into the ESOP market, not only for small businesses, but also into the middle market in order to effectuate transactions at scale, which I think is a useful segue for Stephen, given that Endeavour has been one of the larger platforms that has engaged in the ESOP market, at least opportunistically. So Stephen, would love your perspective as a veteran investor in this field with a larger platform, and how you view EIA potentially making a difference with your strategy and in the market overall.
Yeah, thanks. So I'm a managing director, Stephen Babson, at Endeavour Capital. We're a private equity firm that was formed in 1991, and we've been engaged in ESOP transactions more or less continuously since that time. Beginning with a transaction which is an interesting reflection on your comment about seller financing being required in most ESOP transactions. This was one where we had that element, where we had an investor who had been able to get control of the company through an arrangement where the ESOP was given credit for having a call option on shares. It could only be exercised during a 4-month window, 7 years from the date of closing. And we were able to get in and actually help the ESOP get financing and worked with the company's labor union, so the ESOP was able to acquire 100% of the business. We've been involved in, Vish mentioned Section 1042. In our early iterations of funds, we had individual family members as our LPs. We were really a family office initially. And so for a couple of our first investments, we exited through a sale to 100% sale to an ESOP, with the family members getting 1042 treatment. And as he said, on an after-tax basis, that was a completely fair transaction, although it appeared to be priced at a discount to the market. But the deferral is basically perpetual if you manage that basket of securities right and you can borrow against it. So over time, we began working with ESOPs and trying to find the ideal S-Corp format. And again, this was mentioned earlier, the tax shield provided by being 100% ESOP-owned S-Corp is considerable, and it's a competitive advantage. The problem is that you can't be a private equity firm and be a shareholder directly. And you're also non-qualified because you could be considered as providing a second class of stock. So that was the evolution of this structure that is used today, where the outside equity investor is not actually getting equity, but is getting some kind of mezzanine debt plus warrants that are carefully structured not to trip the disqualification requirement.
Right.
And we have used those, and that led to our creation of a mezzanine fund about 2009. And we used that because that cost of capital was, and that return on capital was better attuned to those types of LPs. And we raised the separate fund. But we also encountered the fact that there was a limit to what we could do in terms of even mezzanine returns in ESOP types of transactions. And so we spun that entity off so it could become an SBIC and take advantage of the then existing SBA leverage that was available. And I'm kind of leading up to why the EEIA is so important here. But the problem then that we found was that the requirement for the limitations on company size under the SBIA guidelines didn't allow even the spun off SBIC to participate in many of the most attractive transactions because they were just too large. And you can see how the EEIA is addressing all of this. And so what we as private equity investors have had to do in the absence of that is we've used a very complicated drop-down structure where we are actually investing directly in the equity of an operating company that is created by the ESOP S Corp. The assets are dropped into the operating company, and the operating company is owned by the private equity firm and by the S Corp that is 100% ESOP owned. It's messy. You have to lease the employees to the operating company from the ESOP, and it's leaky because you don't have 100% tax deferral, but it has worked for us. It doesn't work as effectively as being able to get leverage off the balance sheet through the SBA, and that's what the EEIA does so well, and why I'm anticipating that we would likely be inclined to create a qualifying entity. And we like the idea that there's a category of loan leverage available if you're investing more than 50% of your capital or more than 75% of your capital into ESOP companies. And I think where the private equity universe is going to go is probably these drop downs are going to become rarer, and the larger PE firms are going to either form some kind of qualifying affiliate that gets this SBA status. And
Yes.
A lot of private equity firms like us, I would presume, would get pretty favorable consideration because of investment experience. And then the remainder will kind of figure out, I don't think we can play in this field, and we're going to have to get much better about non-qualified ways of incentivizing the employees. And I second Vish. I don't know that there's any tool for rewarding and retaining employees over the duration of their working career that is better than an employee stock ownership plan.
This is great.
Thank you, Stephen. Well, gentlemen, we're running over on time. So I'm going to give Dick the last word. Dick, in 30 seconds or less, if you could conclude with what should prospective investors in the ESOP market know moving forward? Hopefully, we've discussed some prospective regulatory tailwinds that are in development. But what should either existing GPs, potential LPs, and other stakeholders take away when they look to future opportunities in the ESOP market?
Well, I think Stephen said it well, Vish said it well, and Bryce said it well, and that is, I would encourage them, as I encouraged myself, to listen to Bob Hockett on that train, that there is something out there that I did not know about, but could be really powerful in maturing the idea of EEIA. And that is, if you're investing in middle market companies, US-based companies, and you've never heard of or had any experience with an ESOP, I think learning how they're structured, learning what the return profiles of these companies are, becomes an important new capability and perhaps a motivation for you to find opportunities that otherwise wouldn't present themselves to invest your capital, the LP's capital. But more importantly, what I invite you to do is find out what all of the people on this call have found out as I started my introduction. And that is, I think you'll grow to like ESOPs for a number of reasons, not least of which it can be very effective on return on your invested capital. But there's great rewards for seeing how these businesses who spread ownership throughout the entire organization perform. They're wonderful to share, and you have a ringside seat for doing so. So I encourage you to be curious, listen to these ideas, and
get in touch. Get in touch with
get
us.
in touch.
All right.
Call.
Dick, maybe
Exactly.
just a closing point here is the United States Congress for decade after decade has been a great supporter of ESOPs as a tool for employee ownership and prosperity. And yes, this additional leverage that's going to be available is going to be footed by the taxpayer. But in terms of return on that investment, I think people would not argue that the ESOP community is probably one of the best places to be spending taxpayer dollars right now in terms of creating employment stability and wealth.